I want to talk a little bit about investor behavior. Now, traditionally in economics and finance, we've assumed that participants are rational decision makers, okay, or here we're calling them classical decision makers. But what people who've studied this have found is that in real life, people don't behave that way. And they've found that psychologists have found that there are a lot of biases in the way people make decisions. And this has spawned a new field in economics and finance referred to as behavioral economics or behavioral finance. Now, there are benefits to studying behavioral economics or behavioral finance because, if you're working with a client, there are benefits to understanding how people think so that you can hopefully steer them away from making the irrational decision to making the rational decision. Okay? It may be possible also to take advantage of investors' irrational behavior. When you see the stock market tanking, or you see all of your friends talking about how poorly a stock is doing, you may be able to buck the trend and buy the stock at a bargain basement price. Okay, the two general fields. Let me just cover a few of the things that the assumptions they make. In classical decision making, they assume asset integration. That is, investors look at their entire portfolio. They don't look at one individual stock, one individual investment. They look at their entire portfolio. They also have risk aversion. That is, they look at expected return, they look at variance, which is a measure of risk, and if expected return is held constant, then they look for the asset with the smallest variance, that is the smallest risk. They also assume that rational expectations, that is, individuals are accurate, unbiased forecasters. The competing school is behavioral finance, and it's a blend of psychology with observations of human behavior. In fact, Daniel Kahneman, a psychologist, won the 2002 Nobel Prize in Economics for his work in behavioral economics. If you're interested in behavioral economics, PBS's Frontline did an excellent show on behavioral finance called Mind Over Money, and I'll post the link underneath this video. So here are some examples. In classical theory, they assume risk aversion. Okay, we mentioned what risk aversion was. You consider expected return or expected value relative to variability, which is relative to risk. In behavioral finance, they assume loss aversion. That is, the pain of a loss is greater than the joy of a gain. So investors tend to be overly conservative. And you may have heard people, especially after this last financial crisis, a lot of people talk about, I'll never invest in the stock market. Okay? They didn't like the idea of losing money. Okay? Reference dependence, or no reference dependence in the case of classical theory, assumes that investors look at their terminal wealth value. But what behavioral economists have found is that investors' decisions tend to be based on where they are now relative to their reference point. For example, when I buy a stock, oftentimes that's the reference point. So if I paid $50 a share and it goes down to $45, I'm not thinking about selling the stock even though it's not doing well because it's below my reference point. Okay, so sometimes people will hold on to stocks, and you may have heard people say that. Well, my Apple computer stock went down, but you know what? I'm not going to sell it until I get back to even. Well, if you think it's going to continue to go down, you should get rid of it. But that reference dependence is a real problem. Okay, psychologists have done experiments where they've had participants write the last two digits of their social security number at the top of the page, and then have them bid on a coffee cup. And for example, those that had high numbers in the last two digits of their social security number tended to bid higher. Those that had lower numbers bid lower, even though the social security number has nothing to do with the price of the coffee cup. Reference dependence pops up in marketing all the time. Have you ever noticed that if you go to Amazon.com or you go to a lot of these sites, they'll talk about the manufacturer's suggested retail price is $1,000, but they're selling it for $500. If you check every other site, everybody else is selling it for $500. The actual selling price is $500, but they want you to think that it's a $1,000 item so that you feel like you're getting a bargain by paying $500 for it. Asset integration, we mentioned before that in the classical theory, people look at their entire portfolio. Asset segregation is this behavioral view that people look at each asset individually. Okay? Talk to your neighbors, talk to your friends, talk to your family. They rarely talk about their entire portfolio. They talk about the individual stock they purchased and how well it's doing. They're not thinking about their entire portfolio. Frame independence. In classical theory, it doesn't matter how the question is framed. In behavioral finance, one of the things that pops up is something called mental accounting. That depending on how the question is framed, determines what decisions someone will make. If you've ever taken a survey, oftentimes they ask the same question over and over again, and it's framed a little bit differently, because they want to see how consistent you are in your views. Rational expectations. That is, in this case, individuals are unbiased, rational decision makers. But in real life, people aren't that way. They tend to be overconfident in their ability to predict things. They tend to be overconfident about their own intelligence and their own abilities. People have done surveys where they found that far more of the population rates themselves as an above average driver than a below average driver. If you surveyed people, most people would probably consider that they have above average intelligence. Okay? It can't be. Some people have to be above and some people have to be below, but people tend to think more highly of themselves and their abilities. I'm just going to use the general heading of rational expectations here, is that investors understand random chance and do not draw conclusions based on small samples. But in real life, people do that. People tend to draw conclusions, strong conclusions, from small samples. When you hear about the risk of lung cancer from smoking, there's always somebody who will tell you his grandfather lived to be 95 and smoked 5 packs a day and was never sick a day in his life. That's a small sample. Okay? People tend to do that. People tend to underestimate the effects of random chance. That sometimes you're just lucky or unlucky. In rational expectations, investors don't ignore relevant information. But in belief perseverance, okay, the behavioral finance view, investors tend to ignore information that conflicts with their existing beliefs. You see this all the time. Okay, maybe you haven't thought of it in a finance framework, but you probably know of people, because of religious beliefs, will ignore scientific evidence for certain things. Okay, you'll see people that ignore certain information just because it just isn't consistent with what they believe. Okay, whatever their religious beliefs are, or their political beliefs, okay, they ignore that information. Okay, here's a couple of questions to give you a feel for how they came up with some of these behavioral finance ideas. And this is a common one. You're going to a concert. The concert cost $100. You get to the arena, you found you lost your ticket. What do you do? Okay. Then they ask the question, suppose you get to the arena and you found that you lost $100. So in the first case, you lost your ticket. In the second case, you lost $100. What do you do? Now, these are both the same question. It's going to cost you an extra $100 to go to the concert. What they found is people are far more likely to buy a ticket if they lost $100 than if they lost their ticket. This is where the mental accounting comes from. In the first case, you lost your entertainment money. You have an account that says entertainment money. In the second case, you just lost $100. That could be rent money, that could be food money, tuition money, some other money. So you're more likely to buy a ticket there. Okay. Another example is, here's a way a question is framed as well. Suppose you have the chance to play a game that has a 90% chance that you'll win. Will you play? Suppose you have a game where you have a 10% chance that you'll lose. Will you play? Now again, these are the same questions, right? A 90% chance of winning is the same as a 10% chance of losing, but people behave differently depending on how the question is asked. And when it's a more complicated question, sometimes it's not quite that obvious that it's the same answer. But people tend to behave differently. In rational expectations, classical theory, people always make the right choice, and they always make the same choice if it's the same type of issue.